a few bigger updates that, ultimately impact the cost of capital for borrowers and clients is, really what's happening is this fight on inflation that's persisting. The 10-year treasury is going up. 30-year mortgage rates have kind of shot back up from just dipping below 6% back, kind of in the mid sixes these days. And the big kind of statement coming out of the bigger banks on Wall Street is that they expect now 3 more rate hikes this year, when, it was kind of hoping to be just this one in February and then March and then that terminal rate. And it looks like, potentially there's going to be one more. The Fed president said he's not ruling it out. The data on the, the CPI and core consumer price inflation, all that index is coming in, and it's still pretty high. So that means the banks are forecasting the Fed funds rate to go up to 5.25% and 5.5%, somewhere in there. A third rate hike in May. I guess for us, the takeaway from that is, that information be used to kind of find a sense of urgency with their clients on the DSCR rental loans, and also obviously on our bridge product, just because rates do change and it's pretty volatile still. That's kind of the overlying impetus to get people to look at their deals, structure accordingly, and get them signed up, appraisals ordered, all that good stuff. The other kind of big piece of news that came out this morning was the National Association of Realtors that existing home sales descended another 0.7% in January. So I think that's, another 7th or 8th month in a row where home sales are kind of declining. It's, to be expected after a red hot 2021 and start of 2022. The inventory of unsold existing homes grew slightly. We're sub 1 million at the end of January, to about $1 million, a million homes, and it's about just a shade under 3 months supply at the currently month's sales price. Median home sales, also the price increased 1.3% from a year ago to $359,000. So I'm not seeing a floor, but at the nationwide level, it's definitely sort of plateauing right now on home price appreciation. The chief economist, Lawrence Yun from NAR, noted that prices vary depending on a market's affordability, with lower priced regions witnessing modest growth and more expensive regions experiencing declines. So I think that it's kind of consistent. They're going to see a couple of different data points where the Sun Belt, the Southeast, are seeing, obviously still positive forces, tailwinds on home prices, and kind of the gateway cities, the Northeast, California, are seeing a decline. I guess kind of the exciting part is we all see our clients come back to us with different deal requests. Is inventory remains low, but buyers are beginning to have better negotiating power. So seeing this across the board with, a lot of different kind of quick sales, discounts off listed prices or off market listings, whatever it may be. Homes that, they know that homes sitting on the market for more than 60 days can be purchased for around 10% less than the original list price. So, turning around to a buyer's market, seeing kind of data point from January is that 29% of transactions were all cash sales. And so that's an increase of from December and November. And I think that's kind of with investors starting to come back into the market. In their kind of data metrics, they noted that individual investors, or what could also be a second home buyer, who made up many of these cash sales, purchased 16% of the homes in January. So investors are out there, they're stepping back into the market. Another kind of interesting data point to support all that is John Burns released their quarterly fix and flip survey and kind of had a different look, different take. And so they looked at the buyer type of flipped homes. And so investors are out there, they're stepping back into the market. Another kind of interesting data point to support all that is John Burns released their quarterly fix and flip survey and kind of had a different look, different take. And so they looked at the buyer type of flipped homes. Basically, you could see a lot of people who maybe, see the market teetering out or whatever it may be, but 37% of buyers of flipped homes were entry-level investors. 15% of buyers were kind of move up, luxury home buyers, kind of going and upsizing. And that area, particular segment, saw the biggest decrease. 1% were kind of downsizers, 55% or 55 plus investors, and then 9% mom and pop investors, and then 38% of flipped homes were bought by institutional investors. So kind of a theme that everybody's seen here over the last few years. It's really kind of establishing itself. Kind of heard a lot of it at Mortgage Bankers last week, MBA Craft, with SFR rentals becoming a kind of an institutional asset class, but really kind of tracking that institutional investor. So there's a lot of guys, and we'll see it too, who may be aggregating 3, 4, 5, 10, 15 homes, fixing them up, flipping them to particular REITs that are buying, and looks like to be pretty active in the Southeast. So something to take note of when talking with our clients and what they're doing with their exit. There's another note in this report said Wall Street has purchased hundreds of thousands of single family homes since the Great Recession, basically just showing that home prices, especially in the key Sunbelt states, are growing much more rapidly than the national average. So kind of pushing on the single family rents. Tampa, Florida, and Phoenix, had nearly 35% plus increases in rents from January 2020 to January 2023. So that's pretty massive. That being said, there's been a 24% increase in rents nationwide, and that is starting to plateau out, month over month as we see new data coming in. A couple of big themes to highlight also translates well to our fix and flip business. And what we're seeing is that, basically there's a lot of capital that's out there that's interested in, single family rentals, single family, in multifamily. There's a lot of optimism heading into the second half of the year, and a lot of the optimism is just surrounded with when that federal funds rate is going to hit like its peak rate. So, hoping that's in May, if not March here, but most likely May. Basically what the economic fundamentals are showing is a sort of a soft landing towards the end of this year, not necessarily a deeper recession. Another big theme was kind of looking at, residential and commercial values in kind of the last, 3 or 4 years, and the last 10 years in general. And this current cycle really pushed values way, way up. So kind of some stats that caught my eye were commercial real estate values 10 years ago were at 45% of what they are today. So, obviously a pretty significant increase. CRE values are 67% of what they are today for loans issued 5 years ago, and 81% for debt sold in 2021. So, a lot of those groups had seen pretty rapid value, price appreciation from 2021. So far from July 2022, Real Capital Analytics is only showing a 4% dip in property values so far. That being said, there is a lot of distress starting to hit the market, and kind of talking with various lenders and seeing what they're happening, and kind of seeing the headline notes of even like Blackstone having some of their multifamily portfolios going to special servicing. So I think that the biggest takeaway that was kind of floating around was everybody's kind of, for clickbait, whatever it may be, seeing this panic around values declining, but there's just been a tremendous run up in values. And I think we see that on the residential side too. And so, if you kind of expand the horizon a little bit of where values were in 2020, 2021, 2019, what happens if a 3, 4, 5% dip, it's still pretty high from where they were today. The other big theme kind of looking ahead was that there's a tremendous amount of floating rate debts that maturing on the multifamily side this year. So that being said, there's also kind of a gray area gap in the market for loan sizes, call it sub 1 million up to $10 million in the bridge multifamily side with a fixed rate product. So, as you guys are talking to and kind of looking at deals that come in maybe on the multifamily side, two big questions kind of asked there is, if it's a property that's already owned, is a floating rate loan, and when is the maturity of it? What's the pricing today? What are the pricing mechanics? And kind of get that information. That'll be helpful. And in terms of determining like what you can do and how we size it up and all that good stuff. That being said, the other piece of it is, pushing really that there's a fixed rate product here. I know pricing is high. It's just getting more transparency into pricing on the multifamily side and better pricing. So that's in progress. And it's definitely, there is some light at the end of the tunnel there to get a better product and pricing on small balance multifamily. That being said, that the best lenders are still pricing at, the range of SOFR plus 400, 500. So SOFR on Friday is 4.43%. So if you do the math there, basically the 65% loan to purchase price, loan to cost loan is pricing on the 9-10% rate, even from, a $15 to $25 million bridge loan. Sometimes a little bit better, a little bit less leverage, or a repeat sponsor, whatever it may be. For multifamily, for permanent financing, pricing's coming in the mid fives. So that's kind of the best pricing. Obviously, we're a little bit on top of that, and that's for our rental side, but we did get that pricing increase. And I think there's going to be a more dynamic product going forward as just there's a lot more interest in SFR rentals, and kind of the takeaway there is obviously with interest rates being in the mid sixes and flirting with the sevens, for the consumer home buyer, there's a lot more demand for multifamily and single family rentals. So it's got the attention of bigger institutional investors. Also, kind of the way they see it, tremendous amount of opportunity to lend on these assets. So it expands the horizon for us to be more creative, hopefully in the future. This theme of runway capital. So I was going to say, with one thing we have on the multifamily side, we have fixed rate debt, from $500,000 up to $10 million. That's something to definitely push out there. Obviously, from an Optus perspective, SOFR plus 550, seems like, maybe that's 5.5%. That's double digit interest rate pricing. On our bridge loan product for resi and even multifamily is this runway capital. So runway capital, rescue capital, however you want to see it. But I know everybody's seen these deals where, somebody thought they're going to sell a home in the Hamptons for $4 million and they didn't get it. So they're going to kind of hold on and refinance their existing debt into a new loan, give themselves time to wait for the interest rates to come down a little bit or go to the summer selling season, whatever it may be. Big highlights there, whether it's construction financing or these value add deals, or kind of single family rentals, fixed to rent, across the board. 2021 and 2022 have been very abnormal, excessive, I'm not going to say once in a generation, but once in a long time rent growth, basically pushing 13, 15% in 2021, another 6.5% last year. And so, the trend in rents is definitely moderating. So they're just inching up right now and kind of peaking and plateauing. So it's something to kind of ask for. And you're looking at fixed rent deals, what are your rent assumptions? Is it 3%? Are you trying to double your rents, whatever it may be? The capital markets now are looking at untrended rents, meaning they're not taking into account, excessive rent growth. So all that being said, a lot of information there. Things are still kind of in flux until there's more consistency from the Fed, which will, trickle through to more kind of optimism across the markets. So those are the market updates.